Hey, welcome back. Kai here. Now, there's already a lot of deals in the market today and more to come in the next 12 months, but it can be rather confusing and overwhelming with all the numbers, ratios, and formulas of the stock market. Can we really assess and find what stocks to buy with just one number? The answer is yes. Now, it won't make you an instant millionaire or give you the insight of a crystal ball, but it will allow you to quickly filter out the good companies from the crappy ones. And the extra good news is anyone who can do third grade math can do this too. All you have to do is subtract one number from another. Once we go over that one number, I'll share with you the 5 things I look into for each company before you should pump your hard-earned money into that stock. There are opportunities to be had, money to be made. Let's talk about finding good stocks to buy with one number. Slap hands, bump fists, let's roll. Now, if you're anything like me, you're sitting here in quarantine and salivating at the market. Of course, the given circumstances are horrible and we should all be pulling our own weight to not spread this virus any further. However, the truth is that this recession was coming sooner or later and this virus just happened to drop it off at our doorsteps. Remember, a recession is 2 consecutive quarters of economic decline, which if you watch right here, I tell you why I think that's just around the corner and when you should start putting money into the market. Hint, it's the summer. Now, we can all make money, a lot of money, as investors, but there are 2 qualities you absolutely need. 1, patience, 2, discipline. And then obviously, luck always helps too. Now, if you don't know and are new to the channel, welcome and consider subscribing right down there. I was able to quit my day job and become financially free from the 2009 recession. And now, as of today, or I guess this past couple weeks, I'm going to try and help you do the same thing this time around. Everybody is interested in stocks, but if you listen to the media, day traders, and all these online analysts, they're always talking about different things to pull and push on the market, such as political games, forward projecting PE ratios, volume of trading, etc, 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 etc. My style of investing is a lot simpler, one which I learned from my MBA program and perhaps the most prolific investor in the world, Warren Buffett. It's called value investing. You ignore the hype and media and all the other fancy jargons and formulas, and you flat out only analyze the company at hand and how well it functions, or in this case, operates. You then compare that number to its current market price or stock price. Now, this number is not the holy grail and will not tell you for sure if the company will give you a 50x return or a 100x return, such as Tesla when I only bought 10 shares at $20 in 2009. Still kicking myself for not investing more. But this number I'm going to share with you will be able to quickly tell you at the company, at the core, if it's operationally sound and worth digging deeper into before investing. It's essentially a quick yes/no litmus test. Kind of like Hot or Not for those back in the 1990s and early 2000s when you can just click yes or no, or swipe right or left for you Tinder kids today. Now, the number that I've been leading you up to is basically cash flow from operating activities minus capital expenditures, and it can be found all on the statement of cash flows. Now, let me tell you why it's important, and then I'll show you a website that I use to analyze it, and then some examples of 2 companies I'm looking at to give you a good example of how it works. Fundamentally, at the core of any business, no matter how complex or simple, there's something called unit economics. It can easily fit on the back of an envelope, and it boils down to the essentials of any company to see if the business is profitable or not. It's basically how much you can sell your product for, how much does it cost for you to make said product, variable cost, and how much are your monthly expenses, fixed period cost, and then finally, how many products do you have to sell to break even? That's it. It takes out all other factors of debt, investments, stockholders, and the media. Just the bones of the business. Can it make money? And how much? Now, obviously, as a company grows, hires more employees, creates more products, and even absorbs other companies, its finances can get a bit more complicated. The number that we get from cash flow from operating activities minus capital expenditures is the closest thing to tell us fundamentally if that company is profitable at its core, ignoring the fancy financing by Accountant ninjas. And investing. In business, this is called unlevered valuation. So that's the answer. We want to know if the core of a company is strong, and this number shows it to us basically in a second. What you need to know in this number is that it takes into account the operations of the company, obviously, such as salaries, wages, the cost of producing goods, rent, utilities, etc. But the two really important things this factors in, which you'll want to read up on in the future, is called working capital and capital expenditures. They're a bit more involved than what I want to get into for this video, but these two items can greatly dictate how strong a company's finances are managed. Essentially, working capital consists of accounts payable, accounts receivable, and inventory. Capital X, capital expenditures, are large expenses for items such as land, property, equipment, and machinery. Now, what we're looking for specifically is several years of either steady, positive cash flow, or even better, growing cash flows, which can mean one of two things. Profits are growing because they're selling more products, or they're being more efficient and effective in keeping more money for the company. In the best case scenario, obviously they're doing both. Now let's take a look at a company I personally really like and I'm buying big chunks of whenever there's a large dip. Home Depot. Okay, so this is Home Depot right here, and at the time of this video, they're trading at around $192 a share, and I just bought a ton of it the other day at $130 when the market had a big dip. Now, I personally like Home Depot a lot, and I explained why in this other video, but it's a solid stock and it gives a great dividend of over 3%. However, remember, dividends are not guaranteed, and during recessions, companies are known to pull their dividends if they're hurting bad financially. But if we jump into the statement of cash flows, I'll show what I'm looking at. By the way, I'm using a site called Morningstar.com. It's free to use, but they do have a premium plan so you can see and get access to a bunch of years of data. I really like their site and its layout. It's totally a personal preference. There are tons of other sites that can get you the same info. So right here, I'm gonna click on the tab, Financials, and you'll want to make sure that you're looking at the annual, not the quarterly, but you can dig into quarterly later on when you do a deeper dive. Now, I know if you haven't had a lot of training on reading financial statements, this looks super crazy and is really intimidating. But to be honest, it just looks way more intimidating than it really is. These arrows here just show a subcategory, so this right here is just a subcategory of this and this of this. Okay, some basics of statement of cash flows. It measures three types of cash flows from the company: operations, financing, and investing. Operations is the first one right here, but we want to see the total, so we scroll down a bit, and you can see the investing category starts here, but we'll ignore it for now. So remember when I said you had to do some third grade level math? Well, here it is. Here's the total cash flow from operating activities, and we are going to back out or subtract capital expenditures right here. So for example, in 2019, that was 2.44 billion. We'll subtract that from cash flows here of 13 billion and we get 11.6 billion in cash flows. Now, the reason why I like to take out CapEx is because I'm assuming a part of normal business operations requires a certain amount of machinery and equipment and even property at a Home Depot, such as a giant saw that they have at each location, or the forklifts they use to move around inventory, or the equipment that they rent out. They are essential to the day-to-day business of the company. Therefore, I like to include it as a part of their core business cash flow. So what we can see here is solid, and we can see that they've been growing at a steady pace the last several years, far outpacing inflation. Now we have to remember these were the good years of the economy, so we have to take this data with a grain of salt. Now let's take a look at a different company that everyone, including the media, seems to be hyped up on, and see and check out their basic infrastructure of the business. Uber. Now we immediately see huge losses in cash flow just from operations, so the core business is not yet profitable. It actually has never been profitable. Even less so, we removed the expenses from capital expenditures. So right off the bat, if I had to invest or choose between Home Depot or Uber, I'd obviously pick Home Depot because their business is so much more sound and profitable. Now that doesn't necessarily mean the company is a bad investment just because their cash flows are negative. My goodness, look at Tesla or Amazon, who are negative for a number of years. But we have to understand why they're negative. In both cases of Tesla and Amazon, we understand that they were constantly reinvesting in their own business in departments such as research and design, R&D. They were pretty much the only major players in their spaces, and it was very clear what they were trying to do. Tesla was figuring out how to streamline their manufacturing process to meet demand, and Amazon was doing the same with their shipping supply chain and playing with different products. What's Uber doing? Without a lot of digging, just jumping over to their income statement, I can immediately see that they're dumping a lot of money into their R&D and sales and marketing. The million-dollar question, or billion-dollar, is can Uber outperform and outspend rivals Lyft and soon-to-be Tesla's driverless taxi model? Okay, enough on Uber, we're getting too thick into the weeds. Let's get back to that one number and what to do next. There are 5 things you have to do once you identify a worthy stock. One is you gotta look up the debt that they carry. This can be found on the balance sheet as well as a statement of cash flows. Remember that financing area? Yeah, that's where you'll see it. How much debt do they carry? Is it long-term or short-term debt like a revolving loan? And how much are they paying out each quarter to service that debt? Now remember, debt is not always bad. I talk about this all the time in my videos about leveraging money to buy worthy properties. They could even be using the debt to build some crazy new spaceship-looking headquarters. 2, buying back stock. This can be found in both the balance sheet and statement of cash flows again. Remember, the investing section of cash flows. Now, this can be a good thing and a bad thing, but companies can be buying back stock to artificially increase their stock price, especially if their cash flows and profits aren't the greatest. So this is definitely something to watch out for. It can be misleading to see stock prices increasing, but profits decreasing. Number 3, it's a leadership team. This is where we start getting into the true core of any entity. We all know the names Bill Gates, Steve Jobs, and Elon Musk. They're the celebrities of the business world. But each company on the market has their equivalent of a Gates or Jobs. We have to get a better understanding of what their visions are for the company, what they want to accomplish, and their, probably most importantly, their follow-through rate. Leaders can make or break companies with a swipe of a pen or, this age, a finger. 4, future plans and context. No company can survive by being stagnant. Ever. Each company will always have a future plan. Are these future plans aligned with what society and the government wants? For example, several countries around the world right now are starting to phase out gasoline-powered vehicles in the upcoming decades, even as early as 2030. That means that the context for the fossil fuel industry is about to change significantly. We'll see how well the oil and gas industry will pivot. Number 5, current price of the stock. Now, let's say for a specific company that the previous 4 items all make sense and are pointing to a strong company to invest in. The whole thing about value investing is buying a company at a discounted time. Correction, buying a good company at a discounted time. The whole thing about a recession is you're basically buying good to great companies at a huge discount. But sometimes the price doesn't drop down enough to justify a buy. Now let's use my Apple MacBook Pro here as an example. This brand new was like about $1,800, $2,000. Now let's say that the current market value for this is $1,000. It's in perfect shape, it's in great working condition, everything about it is awesome. Now, if I say to you, I'll sell it to you for $990, would you buy it? Maybe you may buy it if you really need it, but you're not really getting a great deal. Now, what if I needed cash fast because I just lost my job and I was moving and needed someone to buy it within the next hour? So I listed online for $450. I'm willing to bet whether you need a MacBook or not, you'd buy it. If not for yourself, you just turn it around and sell it next week for $800 and make a nice little profit. That's the same thing about stocks. Just because it's a quality company and everything points that things are awesome on the inside, it may not be priced right just yet. Now be sure to subscribe to the channel because in my upcoming videos, I'm gonna go over how to see if the price of a company is a good deal or not. Now remember, it usually takes between 4 to 5 years between market recessions to recover to their previous peaks. That's why discipline and patience can make you a ton of money and it helps you get a few steps closer to becoming financially free. That's the essence of value investing. It's a great tactic for people first starting out and a more conservative way to get a really good return on your money. What companies are you thinking about investing in? I'll take a look with you and tell you what I think. Help me with this video and share it with someone who you think could help or spark a good conversation with. Like this video if you like it. Check out these other videos where I talk about where I'm investing my money and how I'm timing these crazy times to put more cash into the market. Stick with me and I'll do my best to make you some money and hopefully help spread a little education on how best you can invest your money. Love you all. Start using a crock pot. You're too lazy to cook. Kai out.